Hey there, welcome to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day, and today we're going to be discussing how you can build a winning stocks portfolio for 2024. If your goal for 2024 is to build a long-term profitable stock portfolio, start the year by attending our webinar today and learn how you can build a winning stock portfolio in 2024. In our studios, we have investment analyst Danish Lim, and he will be discussing what are some of the sectors you might want to take a closer look into this year. So the outline for today, trends that will define the 2024 stocks market, the importance of a long-term stocks portfolio, are blue chips the way to go? And tech, AI, and ESG themes, which were very popular in recent quarters. How relevant are they for this year? And if before I hand the time over to Danish, I'm just going to do a very quick poll to check if members of the audience, you can hear me loud and clear. I'm going to launch the poll right now. All right, just let me know if you can hear me loud and clear. All right, great. Thank you for confirming that you can hear me loud and clear. All right, at any point in time, if you have questions, please type them into the question box, which you will see on your control panel. It's somewhere at the bottom. Just type your questions in there, and we will address them towards the end of the session when we have a Q&A. In the meantime, Janish, if you're all set to go, I can hand the time over to you now. Are you good to go, Danish?
Yes, sure. We can start right ahead.
All right, Danish, over to you.
All right. Hello, everyone. My name is Danish, investment analyst for Phillip Nova. And for today's webinar, the main topic of discussion will be about building a winning stocks portfolio for 2024. And before we proceed, just a short disclaimer that this presentation is intended for general circulation and educational purposes only, and it does not constitute as financial advice because we do not take into account your specific investment objectives as well as your financial situation. So this is a rough outline of today's webinar. I'll start off by sharing some of the biggest trends that I think will define the 2024 stock market, as well as the importance of having a long-term stocks portfolio in the first place. And then I'll move on and then I'll share our equity outlook for 2024, as well as how I think investors can position their stocks portfolio for the year of 2024. So to start off, our 2024 macro view can be very easily summarized with just three simple words: slow, then grow. And I think the biggest theme of 2024 will be about the soft landing trade. Investors and markets right now, they are expecting the Federal Reserve to be able to achieve a soft landing where they will be able to bring inflation down without triggering a recession. So why are markets currently pricing in this Goldilocks soft landing scenario? Firstly, it's because of disinflation. As you can see from this chart over here, the white line represents the headline CPI, while the blue line represents the core CPI. And both readings, they look to have peaked since the middle of June 2022. Other than that, we also have signs of a very resilient US economy. The latest GDP data is the strongest since the fourth quarter of 2021. And more recently, we also had the Federal Reserve's December dot plot, which essentially tells us the FOMC members where each member project interest rates to be at the end of a specific year. So for example, the 2024 reading over here basically tells us where the Fed, where they believe interest rates will end up by the end of 2024. So their latest December dot plot actually forecast about 75 basis points of rate cuts. However, markets are actually a lot more aggressive when it comes to pricing in these interest rate cuts. Right now, they are projecting rate cuts to first come by March 2024, and that's just 2 months away. However, rather than a soft landing, our main macro view is that we expect an uneven landing to happen. We believe that disinflation will continue. So we expect to see an economic slowdown in the first half, followed by a recovery in the second half of this year. And the main reason is because we are skeptical of a soft landing, as it has happened only once out of 11 tightening cycles from 1965 to 2022. And that was way back during 1994 to 1995, as you can see from this green rectangle in the chart that I've provided. But it's important to remember that the economic backdrop was a lot different. The Fed has hiked interest rates much more today compared to like 50 years or 30 years ago. And something that investors have to always keep in mind is that monetary policy acts with long and variable lags. Academic studies estimate this lag to range from 1 year to 2.5 years. So this means that up till today, we may not have actually felt the full impact of rate hikes. Therefore, we believe that rate cuts will only come in the second half of the year as growth slows down and inflation cools sufficiently. Of course, we do see earlier rate cuts happening if a recession occurs. So there's a couple of reasons why the Federal Reserve is likely to cut interest rates in the second half. Firstly, we have seen a lot of very strong labor market data, and the Fed is very afraid of what we call the wage price spiral. And it's basically a concept which says that if labor demand is very strong, this will result in higher wages, and companies and corporations have to raise the price of their goods and services in order to offset the higher wages that we are seeing. And higher prices of goods and services will result in higher inflation. Other than that, the Federal Reserve is also likely very afraid of prematurely cutting interest rates. Way back in the 1970s, the Fed actually cut interest rates way too early, and this led to a re-acceleration of inflation, which peaked at about 14.8% in March 1980. And then the Fed had to hike interest rates even higher to an all-time high of 20%. Therefore, unless a recession happens or inflation actually re-accelerates, we believe that rate cuts will only come in the second half of 2024. Therefore, for the second half, after the economy slows down, we believe that risk appetite will improve, and therefore stocks will benefit as long as economic growth re-accelerates. However, we do have to monitor the risks such as geopolitics as well as election uncertainty. And the year of 2024 actually has a very heavy election calendar. There's a total of 40 countries that are going to have their elections. The US elections will be held on November 5th. And then the most nearest election will be the Taiwan elections, which I think is being held this Saturday. And at the same time, we have ongoing US-China tensions, as well as two major wars happening across the globe. However, investors have to know that in the long run, the S&P 500 has actually seen an average of about 7% return in the 12 months leading up to the previous 6 US elections. So the moral of the story here is that investors should definitely remain invested, as opportunities will always remain no matter who's president or which party wins the election. And currently, for the first week of 2024, US equities actually saw their worst weekly drop since the month of October last year. And the main reason for this is because investors and markets have been basically taking profit. And we're also seeing a rotation out of the tech sector into defensive sector, such as healthcare, utilities, as well as consumer staples. The reason for this is because labor market data is very strong, and we also had the recent Fed minutes, which really indicated that Fed officials are in no hurry to cut interest rates. So investors have been essentially re-evaluating their expectations of rate cuts in 2024. And moving forward, inflation data tomorrow, which I think will be released at 9:30 p.m., will likely provide further clarity, at least on the trajectory of interest rates. Moving on to the next section, I'll share about the importance of a long-term stocks portfolio. So investors have to know that in the long run, the stock market generates profits much more often than it doesn't. The S&P 500 only saw annual losses in only about 11 of the 47 years from 1975 to 2022. And having a long-term stocks portfolio really also helps you with accumulating your wealth. It will help you beat inflation as well as achieve your financial goals. And more importantly, it also serves as an alternative source of income, which is very important, especially in Singapore, where the cost of living is very high. And another benefit that a long-term stocks portfolio brings is that it will help you take emotions out of the equation. It will help you, it will prevent you from making impulsive decisions, such as buying high and selling low behavior. And lastly, having a long-term stocks portfolio will provide you with a longer time horizon, and where you will generally have lesser risk. And because at the end of the day, even for financial professionals, it's very hard to time the market. Moving on to the third section, I'll share about our equity outlook for 2024. And the first thing to understand is that the reason that the Fed cuts interest rates is also very important. So for example, let's say the Fed, they cut interest rates because of disinflation as well as the soft landing. This is good news for investors. We'll likely see higher corporate profits, which will result in higher stock prices. However, if the Fed cuts interest rates due to a recession, this is bad news for investors, as corporate profits will likely take a hit due to demand destruction, and this will result in lower stock prices. Ideally, you want to see interest rate cuts because inflation has cooled sufficiently enough and not because of a recession. So when you do a scenario analysis, we can see roughly 3 different scenarios playing out in 2024. And right now, the soft landing scenario looks most closely aligned to current stock market prices. And in a soft landing scenario, our preferred way to play the market will be in small caps, emerging markets, as well as disruptive themes such as AI as well as EVs. On the flip side, let's say a recession happens, our preferred way to play the market will be in defensive sectors such as utilities, quality factor ETFs, as well as stocks in the aerospace and defense segment. However, again, our base case scenario is that of an uneven landing, where we expect to see a first half slowdown followed by a second half recovery. And in such a scenario, we believe that the best way to play the market will be to use a barbell strategy. So although the current stock market valuations reflect an unlikely soft landing, at least in our opinion, we believe that there will definitely be pockets of growth opportunities in specific sectors, such as AI, for example. Therefore, with a barbell strategy, this will help investors achieve a balance between risk and reward. So what is a barbell strategy? This is a strategy where investors very simply just focus their investments only on the high risk area of the market and the low risk area of the market, while at the same time completely avoiding stocks with moderate amounts of risk. So the benefit of this strategy is that it essentially allows you to capture profits in the high risk area of the market while balancing out that additional risk with your investments in the lower risk area of the market. And this strategy is very beneficial because, again, market timing is a very difficult thing to do, and investors can very simply just adjust their weights according to different economic conditions. So what do I mean by that? For example, let's say the Federal Reserve cuts interest rates next month, and instead of maintaining a 50-50 portfolio with the barbell strategy, you can very simply allocate more of your investments towards the high risk area of the market, and instead of a 50-50 portfolio, you can make it an 80-20 high risk, low risk stocks portfolio in order to capture the most profits. So this is an example of how we think we can best execute this barbell strategy. From the defensive side of the market, there are sectors such as the utility sector as well as aerospace and defense. And for today's webinar, I'll be diving a little bit deeper into the high risk area of the market and some of the sectors that we actually like. So moving on to the second last segment of this webinar, this is probably the chunkiest and the longest segment. And I'll be talking about how I think investors can best position their stocks portfolio, at least for the year of 2024. So these are, again, the trade ideas which I've mentioned. And I'll first start off by talking about small caps. So what we saw for most of 2023, we actually saw this group of 7 companies called the Magnificent Seven, including companies like Nvidia, Tesla, Apple, and Amazon. These 7 companies actually started to have a very big influence in the market. They actually contributed about 70% of the S&P 500's 2023 gains, and together they hold about a 28% weight in the S&P 500 and nearly 50% of the Nasdaq. So the big question this year will be whether investors should stick with these mega cap and large cap stocks, or should they take a shot or take a chance on the rest of the market. For us, we actually prefer small caps over large caps, and there's a couple of reasons why. Firstly, we find small caps attractive because their valuations are extremely cheap, and the fundamentals also appear to be improving, especially when we consider that a soft landing may happen and we may see rate cuts as well as disinflation. So a good way to identify profitable investment opportunities in the small cap space will be to do equity screening. And I'll elaborate more on equity screening and the reason behind some of my criteria a couple of slides later. And more recently, we're also seeing the stock market rally actually broadening beyond the tech sector. For the month of December, you can see over here that the Russell 2000 index, which is the orange line, it actually massively outperformed the S&P 500, which is the yellow line, as well as the Magnificent Seven, which is the white line. And this tells us that capital or money is actually starting to flow into small caps. So what this means, again, is that as long as the soft landing narrative gains traction, and as long as markets are continuing to price in rate cuts to happen this year, we should continue to see small caps gain. We should continue to see more and more upside for small caps. And there's a couple of reasons. And the biggest reason is probably because small caps are historically more economically sensitive, and they tend to outperform large caps, at least during market recoveries. You can see from this chart over here, which shows that during the, after the global financial crisis, from March 2009 to the end of May 2009, small caps, which is the white line, actually outperformed large cap stocks, which is the blue line. We saw, the same thing happening after the COVID pandemic. From January 2021 to April 2021, small caps again outperformed large caps. Other than that, the biggest reason, again, for our preference for small caps is their very attractive valuations, and they currently have a valuation gap to large caps. And using the S&P 500 equal weighted index, which is basically an index where they equally weigh all 500 companies in the S&P 500, compared to the normal S&P 500, which gives greater market weighting to stocks with larger market caps. So very simply, the equal weighted index is usually used as a sort of a proxy for small cap companies. And if you were to compare the equal weighted index and the S&P 500 based on their PE ratio, we see that currently the equal weighted index is trading at a discount of about -3.8 in terms of PE ratio. And this is near the all-time record discount, which is about -4.07. So small caps are trading near their all-time discounts to large caps. And if you were to look deeper into the statistics, we see that historically, at least since 2010, both indices, they typically trade at similar valuations. The mean is about 0.06, which is almost negligible. And this tells us again that this discount between small caps and large caps is actually out of the norm. And if you were to look at the normal distribution curve, we see that the current discount of -3.8 is actually more than 3 standard deviations away from the mean. So the moral of the story here is that valuations for small caps are extremely attractive right now. So when it comes to screening, we'll use the Russell 3000. And our first criteria is that we want to avoid companies with over-leveraged balance sheets or companies with too much debt. And for this equity screening, we want stocks. We will prefer to use EBITDA, which essentially refers to earnings before interest, tax, depreciation, and amortization. And the reason why we use it is because it's generally a better indicator of a business's ability to generate profits by excluding the impact of accounting and financing decisions, at least when it comes to tax and depreciation. So for our screening, we look for stocks that are the bottom 25% in terms of their net debt divided by EBITDA in the Russell 3000. And the reason why we want stocks with as little debt as possible is because with high interest rates, companies with higher amounts of debt will actually suffer the most, and they are exposed to more interest rate risk. And then next, we also want stocks with high EBITDA margin, and which basically tells us which companies have higher pricing power. So we want stocks which are in the top 20% in the Russell 3000 in terms of their EBITDA margin. Lastly, we're also looking for rebound candidates, companies that are down more than 20% from their 52-week highs. So when we do an equity screening, we see that this gives us about 36 companies. And these are the 36 companies that we actually generated through our equity screening. And most of these companies, I'm pretty sure, most of us have probably never heard of them before, but there are familiar names such as Charles Schwab, On Semiconductor, who they basically make semiconductors for EV companies. Then we also have Moderna at the bottom over here. So, however, let's say you don't want to go through the hassle of screening for stocks, and you want to reduce your company-specific risk. You can very simply instead, look at small cap ETFs. We have very generic small cap ETFs, such as the iShares Russell 2000 ETF or IWM. We also have the value or growth factor ETFs, and what these ETFs do is that they basically target companies with specific characteristics. For example, the Vanguard Small Cap Value ETF or VBR, they target small cap companies that are perceived to be undervalued. And then lastly, we have some of the more unique ETFs, such as the Pacers US Small Cap Cash Cows 100 ETF. That's a pretty long name, but essentially what they do is that they track small cap companies with very high amounts of free cash flow. So this is another way that investors can look to play the small cap market. Moving on to our next trade idea, I'll be talking about the disruptive themes such as AI and as well as the GLP-1 weight loss drugs. So for AI and semiconductors, the important thing is that investors have to distinguish between semiconductor devices and as well as semiconductor manufacturing. Not many of us, I believe, are actually aware that NVIDIA does not actually produce their own chips. They actually outsource the manufacturing of their chips to TSMC, or Taiwan Semiconductor Manufacturing Company, which is a Taiwan-based company. So the semiconductor industry, they function based mainly on this foundry fabless business model. So what does this mean? It's important for us to understand some key terms. Firstly, when we say or when we talk about a foundry or a fab, we are referring to a semiconductor fabrication plant or a semiconductor factory. And the term fabrication refers to the process that is used to manufacture and essentially produce these semiconductor devices. So when we talk about fabless companies, we're actually referring to companies such as AMD, NVIDIA, Qualcomm, who do not actually have their own factories, but what they do is that they focus purely only on the R&D side of things. They focus on researching and designing chips, and then they'll outsource the manufacturing of these chips to foundries such as TSMC, UMC, and Global Foundries. So foundries, basically, they only focus on simply manufacturing the chips. And then in the middle, we have IDMs. IDMs refer to integrated device manufacturers, and they essentially have their own factories, and they also produce their own chips. So when you look at the foundry market, we can see that TSMC has by far the largest market cap. Their market share is over 50%, and we also have other companies in the foundry segment, such as Samsung Electronics, Global Foundries, which is a US company as well. However, the entire semiconductor ecosystem is actually far more complex than what I mentioned. There's a lot of different companies along the value chain. For example, we also have raw material suppliers, companies that provide companies like TSMC with the raw material. They provide TSMC with silicon, and silicon is a very important raw material for semiconductors. For this webinar, I'll briefly talk about the assembling, testing, and packaging segment, as well as the equipment suppliers segment. So for equipment suppliers, they are essentially companies that provide foundries such as TSMC with the equipment that they need to manufacture chips. And we have Applied Materials, ASML Holdings, and Lam Research, who are the biggest players when it comes to equipment suppliers. And then moving on to the assembly and packaging segment, essentially, after the chips are manufactured, they need to be assembled and then packaged into a finished product, which is then ready to be delivered and sold to companies like Apple, Microsoft, and Meta. And in this segment, we have MCore Technology, which is a US company, which is a very big player, as well as ASE Technology. And it's actually a Taiwan company, and they are the biggest player when it comes to the assembly and packaging segment. Lastly, we have the testing segment, where these companies, they focus on testing new chips in order to ensure that their quality and reliability is up to standards. We have the Japanese company Advantest, Disco Corporation, and then the US company Teradyne. And one key driver for this segment is that generative AI is expected to create more complex chips, and this will necessitate more stringent testing methods, which basically benefits some of these companies as well. So now we'll talk about semiconductor devices, and this is different from semiconductor manufacturing because these companies, they basically already have the finished product, and what they do is that they focus on selling it towards their different end markets. For example, NVIDIA and Intel, they produce the chip, and then they'll sell it to whichever company is actually produces this laptop. So the first thing to understand for the semiconductor industry is that it's a very cyclical industry that is highly dependent on business and corporate or consumer spending. For example, Dell, Lenovo, and HP, they produce computers, PCs, and laptops. And what they do is that they will buy semiconductors or chips from Intel, and then they include it inside their products. However, let's say that these three PC companies, they anticipate consumer demand to be very poor in 2024. Therefore, what they'll do is that they will order less amount of chips from Intel. And this will result in very poor sales figures for Intel, which will result in lower stock prices. Something else to know is that during the pandemic, a lot of these chip companies, they actually overstocked on their semiconductors because they believe that demand for devices, electronics will increase due to more people going online as well as working from home. At the same time, manufacturers like Intel, they increase their production in order to meet demand. However, starting from last year as well as after the pandemic, we actually saw businesses starting to pull back on their spending. They ordered less amount of chips because of high interest rates. And at the same time, demand actually came in a lot weaker than expected due to macro uncertainties. And what ended up happening is that in the semiconductor industry, we actually started to see a lot of companies having excess inventory. And this led to lower prices for some of the chips that they're selling. You can see from this chart over here that inventory levels actually from sometime around 2022 onwards actually jumped a lot higher to an all-time high. Thankfully, recently the inventory levels in the semiconductor industry, they actually they appear to be starting to normalize. Investors, I think, also have to understand that the semiconductor industry is a very huge industry. Not all companies will benefit from AI. If you were to see this screenshot I took on the right, you can see that the PC market, as well as the communications or the smartphone market, they have by far the largest market share. And AI or data centers, they actually make up only a very small portion. They only make up about 5 to 6% of the semiconductor industry, and they actually fall within the industrial segment. So the moral of the story is that different companies specialize in different types of chips. And based on their specialization, all these companies, they will have different valuations based on their different end markets. You can see on this screenshot I took where I ranked all the different semiconductor companies based on their price to sales ratio. So firstly, for companies that produce logic chips, they are basically chips which process data. These companies include NVIDIA, Advanced Micro Devices. They have the highest valuations due to the exposure to artificial intelligence as well as data centers. Below them, we have companies such as Texas Instruments as well as Analog Devices. They produce commodity chips, which are essentially chips that are very widely used. For example, Texas Instruments, they produce chips that are used in a lot of the calculators that you see out there. So valuations for these companies have been relatively steady, and usually we refer to these companies to be slightly more of a defensive semiconductor company, because demand for these commodity chips are usually more stable. And then we also have companies that produce smartphone chips, such as Qualcomm, MediaTek, and Skyworks. Their valuations actually seem to be pretty depressed, probably due to a lack of demand in China, as well as a longer than expected inventory correction. Lastly, we also have companies that produce memory chips, which are typically included in your laptops and PCs, companies such as Intel, Samsung, and SK Hynix, which are Korean companies. And the reason why their valuations are also pretty depressed is mainly due to the same reasons as the smartphone market. However, our main view for 2024 is that we expect it to be a year of growth for semiconductor devices, because we expect to see inventory levels start to normalize. We expect demand to recover, especially in the PC segment and the smartphone segment. And at the same time, AI will definitely AI will definitely boost demand for semiconductors. Some of the latest data from the Semiconductor Industry Association, or SIA, actually showed that global chip revenue in November saw its first year-on-year growth since August 2022. And this basically tells us, and it serves as a sign that semiconductor demand could be coming back. There also has been a slight rebalancing of supply and demand within the PC and smartphone market. You can see from this chart over here that starting from second quarter of 2023, the mobile phone shipments actually seems to have rebounded, from their all-time lows. So when you categorize all these different semiconductor companies based on the different, end markets, for the AI and data center segment, we expect AI to propel capital expenditures among cloud providers and hyperscalers. This refers to companies such as Meta, Microsoft, who basically need the chips provided by these companies in order for some of their AI applications, such as ChatGPT, to function. And because of AI, companies that produce some of the AI-related chips, such as GPUs, will benefit in 2024. Other than that, for the PC segment, we expect to see a rebound as long as inventory levels normalize and demand recovers. Something interesting to note is that a lot of companies, they have yet to go through this PC refresh cycle, which is basically a phenomenon where a lot of companies, they will update or upgrade their commercial PCs into newer versions. And historically, this refresh cycle typically takes about 3 to 4 years, but most companies in the US have yet to actually update their PCs ever since the pandemic. Lastly, for the smartphone segment, the transition to 5G should continue to drive demand. And we're also seeing Chinese consumers start to spend on mobile phones, as seen by Huawei's resurgence. However, iPhone demand still remains pretty weak, and therefore we actually believe that the smartphone segment, as well as smartphone companies such as Qualcomm, Skyworks, Qorvo, as well as MediaTek, they will probably be the slowest to recover. Then moving on to our next trade idea, I'll share about the overlooked stars of 2023, or the GLP-1 weight loss drugs. So what these drugs do is that they mimic the hormone called GLP-1, and what this hormone does is that it sends a signal to your brain that your body is full after having a meal. So currently, there are only 3 of these drugs on the market that has been approved for obesity treatment. They include Novo Nordisk Saxenda, as well as Wegovy, as well as Eli Lilly's Zaobao. The very popular Ozempic drug is only approved for use as a diabetes treatment. And in Singapore, these drugs are available actually for purchase, but you can only get them with a doctor's prescription. And these drugs are so popular that they have even been mentioned at the Oscars, mentioned by Elon Musk. They are featured in countless TikTok videos, and they are even mentioned in a YouTube song. So these drugs are, they are currently very, very popular, and you will likely see a lot of headlines on some of these companies as well. And because of these drugs, Eli Lilly, which is a US company, and Novo Nordisk, which is a European company, they became the 2 most valuable drug makers in the world. Novo Nordisk even actually overtook LVMH to become Europe's biggest stock. And when you were to look at their market cap, you can see that Eli Lilly's market cap of about 580 billion is actually higher than if you were to combine the market cap of Johnson & Johnson as well as Pfizer. And for most of last year, Eli Lilly and Novo Nordisk actually returned about, they actually generated returns of over 50%, which is a very significant number, especially for a healthcare company. And focusing more on Novo Nordisk, it's actually a Danish pharmaceutical company. It's based in Denmark, and their original business focus was on making diabetes treatment. You can see from this image at the bottom that diabetes care made up about 72% of their third quarter revenue. However, more recently, obesity drugs, which includes the weight loss drugs, have been generating more and more revenue. And in the third quarter, the sales of Wegovy actually reached about 1.4 billion US dollars. And this is an increase of about 734% year on year. And quite interestingly and quite shockingly, the market cap of Novo Nordisk has actually exceeded the entire annual GDP of Denmark. So again, there's a lot of hot headlines as well as explosive numbers when it comes to these weight loss drugs. So who are the potential winners other than Eli Lilly and Novo Nordisk? Biotech companies and other pharmaceutical companies such as Viking Therapeutics, Pfizer, and Amgen could also benefit from joining the obesity drug race. But currently, they are still awaiting trial data before they can actually launch some of their products onto the market. We also have drug distributors such as Cardinal Health, McKesson, and Cencora, who basically distribute some of these weight loss drugs to the public. And then we have contract drug manufacturers like Thermo Fisher and Catalent, who their main job is to basically fill the injection pen or the syringes for Wegovy. And this is because Wegovy is actually a self-injected medicine. Patients who use Wegovy have to inject themselves with it. And this process of filling this injection pen is called the fill-finish process. And this is actually a very complex process, which is why companies like Novo Nordisk, they will contract and they'll outsource this entire process to companies like Thermo Fisher. Lastly, we also have companies like Stevanato Group, as well as West Pharmaceutical Services, who basically make the components such as the rubber plunger and the glass cartridge, which are used in the GLP-1 injection devices. So the potential underperformers include medical device companies such as Insulet Corporation, Abbott Laboratories, as well as Baxter International. And the reason for this is because most of these companies, they manufacture devices such as insulin pumps or glucose monitoring devices. And they have actually reported that some of their devices and sales have seen are being impacted by these weight loss drugs. We also have companies that are exposed to obesity complications. Companies such as ResMed, they make products that treat sleep apnea, and studies have shown that about 70% of patients with sleep apnea are actually obese. And then we also have Zimmer Biomet, who sells joint replacements. So these companies who they treat obesity complications, they may also see demand for their products being affected. And of course, we also have fast food companies like Wingstop, Wendy's, as well as Shake Shack. And we are actually pretty bullish on these weight loss drugs. Estimates suggest that around 42% of all American adults, they actually have obesity. And it's also very important for Novo Nordisk and Eli Lilly to increase their production capacity and attain the first mover advantage, because currently both companies have reported that they are struggling with a very big shortage of these weight loss drugs, simply because demand for them has been way too overwhelming. Lastly, the key growth driver for this segment will be the potential expansion of these weight loss drugs to other use cases or other medical conditions, such as Alzheimer's, kidney diseases, as well as cardiovascular diseases. There was a recent study which showed that some of these weight loss drugs were actually able to reduce the risk of cardiovascular diseases by about 20%. So this is a very key growth driver, and you may actually see, the consumer base of these weight loss drugs expand beyond simply obesity patients. Moving on to the final trade idea, I'll talk about emerging markets as well as some of the Latin American equities. So when we talk about emerging markets, we are usually referring to countries such as China, India, Taiwan, South Korea, Brazil, and even Saudi Arabia. And it may come as quite a surprise to find that South Korea is included under an emerging market. There has been a lot of discussions and talks that they may, they may move South Korea from the emerging market index and into the developed market index. So that's something to keep in mind moving forward. But the biggest takeaway I want you guys to understand is that China is probably the country that has the biggest impact on emerging markets. So the key growth driver for emerging markets will be a weaker US dollar. And we expect a very bumpy start to 2024 for emerging markets, but they should start to become more attractive as we move through 2024, especially once the Federal Reserve starts to cut interest rates, which will result in a US dollar. And historically, at least from 2014, the emerging market index actually has quite a strong negative correlation of about negative 0.6 to the US dollar. And one reason for that is because a lot of these countries or emerging market countries such as Brazil, they are actually highly dependent on commodity exports. And these commodity exports, they're usually priced in terms of the US dollar. So when the US dollar gets weaker, demand for their commodities actually increase because it becomes cheaper. And this will benefit some of the more export-oriented emerging market companies. So these are some emerging market products that are on our watch list. We have emerging market ETFs such as IEMG. And for investors who want to reduce their exposure to China, there's also the emerging markets ex-China ETF, which basically covers all the emerging market countries other than China. And then for Latin America, we have the iShares Latin America 40 ETF. And something quite interesting is that not many people are aware that Latin America was the top regional market in 2023. Latin America even outperformed Japan, they outperformed India, and they even outperformed the US. And one key, and when we talk about Latin America, usually we're referring to 5 countries, Brazil, Mexico, Chile, Peru, and Colombia. But it's important to know that usually Brazil and Mexico, they have the biggest weightage when it comes to Latin America equities. And the key driver for Latin America is that the central banks of Latin America, they are actually ahead of the curve compared to US and other developed markets. They are ahead of the curve when it comes to cutting interest rates, because most of the central banks in Latin America, they actually started their rate hike cycle relatively early in 2021. You can see from this chart over here, the white line represents the Brazilian interest rate. And you can see that the Brazilian central bank actually started hiking interest rates as early as March 2021. On the other hand, the Federal Reserve actually started hiking interest rates only in sometime around March 2022. And because they started their rate hike cycle earlier, inflation actually peaked earlier. And for Brazil, they've already started cutting interest rates. And you can see that they actually started to cut interest rates as early as August of last year. And this creates a very supportive environment for equities. There are also other good reasons to be bullish on Latin America. As I've mentioned, inflation has already peaked. And in terms of valuation, Latin America equities are also very cheap. And they're also likely to become a beneficiary from nearshoring due to their very close proximity with the US. We're also seeing more and more companies moving their supply chains away from China and into Latin America countries. I'm sure you guys may have heard that Tesla is also considering building some factories in Mexico. Lastly, the Latin America region also plays a very important role in the EV supply chain. They own over half of the world's lithium reserves, as well as around 36% of the entire world's copper reserves. So now I'll move on to the last segment, and I'll very quickly summarize some of the key takeaways from this webinar. So for our 2024 equity outlook, first, we again expect an uneven landing, and we believe we may see a slowdown in the first half, followed by a growth re-acceleration in the second half. At the same time, investors should remain invested for the long term because it will help them accumulate wealth, and it will also help them take emotions out of the equation, and it's a form of preventing yourself from trying to time the market. Lastly, again, we think that a barbell strategy is suitable for an uneven landing, and investors can simply adjust their weight or their allocations based on different market conditions. And we think that this is a good example of how we can execute this barbell strategy. For some of our technical views, we like small caps because of their cheap valuations, as well as some fundamental signs that appear to be improving. These are the stocks that we generated through our screening. They include companies such as Charles Schwab as well as Moderna. Other than that, investors can make the process much more simpler by looking at small cap ETFs such as the iShares Russell 2000 ETF or IWM. We are also pretty bullish on semiconductors because they will benefit from inventory levels normalizing, demand recovering in the very important markets of the smartphone market as well as the PC market. And AI should continue to drive and boost demand for semiconductors. And we also think that GLP-1 weight loss drug winners also have a lot of potential. This includes biotech firms, drug distributors, contract drug manufacturers, as well as the makers of the components used in the injection devices. This includes companies like Thermo Fisher and Catalent for the contract drug manufacturers, as well as Stevanato Group and West Pharmaceutical Services for component makers. And we also like emerging markets because of their inverse relationship to the US dollar, which is very high, and we are likely to see the US dollar depreciate this year due to interest rate cuts. And investors who want to de-risk from China can look at the EM ex China ETFs. Lastly, we also like Latin America because they are ahead of the curve, especially when it comes to cutting interest rates. And they are also a nearshoring beneficiary and a key raw material supplier for electric vehicles. And these are some of the EM products or ETFs that are under our watch list, including the iShares Brazil ETF or EWZ, or the iShares Emerging Markets ETF or IEMG. And with that, we've come to the end of the presentation. I may have exceeded the time, but I hope you guys have learned something useful, and we'll proceed with the Q&A session. And I'll hand over the time to Sri.
All right, thank you so much, Danish. All right, the time is now for you to ask some questions so Danish can address them and you'll be better prepared for the opportunities that are coming up in the year ahead. First things first, we have, let me see, do we have questions? Okay, we have a question from Ian. Ian is asking, for the ETFs that you featured, okay, Ian, maybe you need to let us know which ETF you're referring to. Is there a specific slide for which you're wanting to know the expense ratios for? And then we can have Danish address them. We have another question from Han Cheng. Can you explain a little more on the logic between USD weakness and emerging markets? Also, what are some risks for the emerging market segment?
So firstly, to address your first question, the US dollar and the emerging markets have an inverse relationship. So when the US dollar weakens, historically, we see that this benefits emerging market stocks. And one reason for this is because emerging market countries like Brazil, Mexico, and Colombia, they are very dependent on exports, commodity exports, such as coffee, corn, and other things like that. And most of these exports, they are actually priced in terms of the US dollar. So let's say the Federal Reserve, they cut interest rates. Usually what we'll see is that the US dollar starts to weaken after the Fed cuts rates. And when the US dollar weakens, these commodity exports, such as coffee, they become cheaper. And when they are cheaper, we'll see demand for things like coffee, corn start to increase. And because of that, when with higher demand, a lot of the companies under the emerging markets, they are also very export oriented. They are a lot of them are like basically material suppliers, and with higher commodity prices, this will also mean that their revenue will increase as well. And some of the risks that emerging markets face, of course, the biggest risk I can think of is political risk. The emerging market, countries like Brazil, Mexico, historically, they haven't been very politically stable. And that's one risk, or that's one factor to consider. I would suggest that people who are interested in emerging markets should continue to monitor the headlines and check out and see whether some of these countries, whether they are going through any form of political instability. And I hope that answers your question.
All right, Danish, thanks for that. Can I check for okay for the market situation right now? Would you say it'll be an ideal time to invest in SG REITs? If not, if so, why?
I think for that question, if you were to look at the my barbell strategy slide, uh, the SG
Should be
REITs.
able to show us that slide again, Danish.
Let me. Yeah, the S REITs or Singapore REITs, they actually fall, I think, more under the defensive segment because they provide regular income. Although that may not be, actually fundamentally correct, but I kind of prefer, or I kind of like their regular, income or dividend payments, as it'll help to cushion against market volatility. And in terms of the, fundamental outlook, or the economic outlook, typically S REITs or REITs in general, they will also benefit from interest rate cuts. And for Singapore and S REITs, it's pretty likely that the Monetary Authority of Singapore, or MAS, they should start to lower their exchange rate. So this is maybe going a bit off course, but Singapore, they manage their interest rates or monetary policy using the exchange rate. They don't actually manage monetary policy based on interest rates. And basically, Singapore is also expected to start easing on the monetary policy, and in such a scenario, S REITs will also benefit. So to answer your question, yes, I think S REITs, they have quite a good outlook, at least for 2024.
All right, we should have time for two more questions. We have one from Nicholas that just came in. Danish, are you bullish on any SG semiconductor companies?
Yes, so for SG Semiconductors, I actually plan to include one slide, but I actually removed it. Singapore actually has a few companies that have some form of exposure to semiconductors. Off the top of my head, there's this company called, if I'm not wrong, Franken Group. And if you guys can Google Franken Group, it's actually a company which provides some of the electronics and equipment to some of these semiconductor companies. And if I'm not wrong, they actually provide on semiconductor with some of the equipment or tools that they use throughout the manufacturing process. And other than Franken Group, I believe there's also another company. I think it's AMS holdings. Yes, but there's a few companies, and if you are interested, maybe I can get back to you after this webinar.
All right. Okay. So Danish, I think we should have time for one more question. Maybe you have covered quite a bit today, and give us some highlights on specific sectors and stocks to keep a close watch on, as well as you've given us your views. Maybe as a key takeaway, what are three things should we remember or take away from today's session?
So something I think or a key takeaway from today's session, firstly, is that the most important thing is, of course, investors should stay invested in the long term. I've explained the benefits of a long-term stocks portfolio. You can very easily remove some of the emotion and psychological reasons when it comes to investing. Another reason or another big takeaway today is that there are definitely a lot of attractive opportunities outside of the US. Very frequently, I hear a lot of investors, they kind of over focus and over concentrate on the US side of the market. And this means that a lot of other regional stocks, as I've mentioned, emerging markets, Latin America, a lot of them have very little attention. And I believe that because of this lack of attention, they are actually also very, very attractive investment opportunities. And lastly, again, investors or the audience, I believe that we should all monitor the markets as well as always try to balance out our risk. And this is why I also prefer, or why I think a barbell strategy is very good.
Right. Thank you so much, Danish. Before we end the session, I just wanted to quickly share some promotions that Phillip Nova is currently having. Let me just quickly jump to my screen. My screen. Okay. Let me just. Okay. Okay, so Phillip Nova is currently still having, we are in our last month of our 40th anniversary giveaway. If you open and fund your account, you stand to receive some exciting gifts. This month, you get to experience a gourmet dinner for two. So you open an account and you fund your account, you stand to receive a gourmet experience for two. Additionally, if you're already a customer, you stand to win too. You stand a chance to win an iPhone 15 as our top prize for our last lucky draw at the end of this month. All right, so if you want more learning opportunities, fret not. We have an exciting seminar coming up on 19th January. It promises to be the only Forex seminar you need to get started with Forex trading. If you are keen to sign up or learn more about this seminar, just scan the QR code that you see on your screen. Okay, just to recap, we for new customers, you get to receive a gourmet experience for two when you open and fund your account with Phillip Nova. You can trade all the stocks shared by Danish today in his presentation with the Phillip Nova 2.0 trading platform. Okay, and additionally for current customers, you stand a chance to win an iPhone 15, an IKEA gift card, as well as a Dyson air purifier, as long as you trade any product from now to end of this month, and you will stand a chance to win great prizes in the lucky draw. Additionally, last but not least, is our upcoming seminar on 19th January. Tickets are selling really, really fast for this event, so to avoid disappointment, please register now. And all right, and that marks the end of our live webinar for today. Danish, thank you so much for your time and your valuable insights. I really enjoyed them. I will definitely tune into the video recording for this session so I can revise on what was covered. Thank you, Danish.
Sorry, before we end, getting back to the question that someone asked about the Singapore semiconductor companies. I've just remembered the name of the company, and you guys can do a quick Google search. The name of the company is called AEM Holdings, and what they do is that they provide testing solutions for semiconductors. So, for example, once a semiconductor is manufactured, AEM Holdings, they will test the quality as well as the reliability of some of the chips. Yes, so that's quite a potentially promising Singapore company as well.
All right, there you have it from Danish. He promised to come back, and he has come back with AM Holdings. That's the other semiconductor company based in Singapore that you might want to look at. Thank you so much, Danish.
Thank you. Thanks, guys, for listening. Appreciate
Have a
it a
good
lot.
night. And until our next session, all the best with your trading.
Yes. Good night.